Unlock the secrets to smart home ownership and financial success with Home and Finance Insights. Whether you're a first-time buyer, seasoned homeowner, or real estate professional, this podcast delivers expert advice on home financing, insurance, tax strategies, wealth building, and more. Hosted by a mortgage and real estate pro who's been in the game for decades, we interview top industry experts to share actionable insights that help you protect, grow, and maximize your home investment.
Welcome to Home and Finance Insights. I'm your host, Kevin Mathews, and today we're going to talk about homeownership and income taxes. Joining me is George Graziano from Tax Plan Pros out of Auburn, California. George has been gracious enough to take time from his busy schedule to share his knowledge and insights of the tax world. So George, please tell us about yourself, your firm, and what you like about being a CPA.
Thanks for having me today. I'm a CPA. I've been one for a while, been in the world of tax preparation, tax advice, tax planning for quite a long time. Graduated from college back in 1988 with a 4-year degree in accounting, and I've basically stayed in the accounting profession the whole time. Started as an auditor, discovered I didn't like doing that job, but it introduced me to the world of CPAs, how they represent their clients, how they advocate for their clients, and that set me on the path, eventually establishing my own practice. Like many CPAs back then, I started in the world of financial statement auditing, where you had to start to get your certificate. It was several years before I really jumped in with both feet into the world of taxation. And that really changed my life. It changed the work from numbers on a piece of paper that not too many people cared about to a situation where I was impacting people's lives by the work I did. And there was real money at stake for real people. And it really cemented my career choice and has kept me in taxes. And the best part of my profession to me is the people side. You know, working with people, developing relationships, understanding what their situation is, and helping them, deal with their tax burden as they progress through life. It's a big cost for anybody who's financially successful, and it matters a lot that they get, good service and good kind of communication about their situations.
I can attest to that, because when I first met you years ago, you invited me to your office and we sat down, myself and my wife, and we had a good discussion about not just our tax liability at that time, but just about life in general and the goals and the dreams that we had. And I remember really being impressed that you took the time to figure out what we're trying to do with our life and how taxes fit into that.
Yep.
Yeah.
Okay.
When I thought about having you on the podcast, I envisioned the episode to really help people understand how home ownership can affect income taxes.
Yep.
But it's such a broad subject, and every person has a different scenario. So any real advice, I guess, has to be generalized just for this podcast.
It does. That's a good point you bring up. Yeah, what we're going to discuss today are general rules. For all the general rules, there are exceptions which may or may not apply to an individual situation. And therefore, the tax rules even that they have to follow could be different than the next client. We're going to talk about the general rules to give people some base knowledge. And if they want to dig deeper, they can do that. But this will give them a good base of understanding. The other thing I want to touch on is I want to be throwing out some specific rules. These are all federal income tax rules. An important point to remember is there's also California income tax rules to follow. The new tax bill that got passed at the federal level just this year. California does not comply to essentially any of those new rules. So that just made the gap between federal rules and California that much wider. Today, we're talking about federal rules.
Okay, fair enough. So let's start with the basics, and that would be tax benefits for someone that owns a primary residence. A mortgage interest deduction, who qualifies for it?
Taxpayer needs to be living in their primary home, and they need to be liable for the debt.
When you say liable, you mean that they're the ones that are responsible or are making the payments.
You have to be physically making payments on the loan to get the deduction. Say there's two people who own a home. They're not married. They're just cohabitating or have co-ownership of the home. They're both on the debt. Only one of them may get a 1098 from the bank or the lender. But if, both are responsible on the loan, both are paying their share of the loan, both can get the mortgage deduction, on their respective tax returns.
In that case, they'd have to split it, though. They couldn't both,
Yep.
take the same deduction overall.
Yeah, they would only get their respective share.
The total.
Exactly. Yeah.
Okay. So how does that work as far as the mortgage interest deduction versus the standard deduction?
Yeah, so a couple other things on the mortgage deduction. One thing I didn't say is the loan, in addition to being secured by the home, the proceeds of the loan have to be used to either buy, build, or improve the home. For, a purchase money loan, that's pretty obvious, right? But if it's a loan to, to build it or a loan to improve it, that also can qualify as mortgage debt. There, you've got, your task is to document, that you used the proceeds for that purpose. The other thing is there is a debt limit on mortgages. So the current debt limit is $750,000. And what that really means is, if you have $1 million mortgage on your home, and the debt limit on deductible interest is $750,000, you're only going to get to write off potentially about 75% of your mortgage interest on that loan. And that limit used to be $1 million. So 2018 it changed. So if you have an older loan, even if you've refinanced it but haven't taken any extra money out, you still have $1 million limit on that as it relates to that loan. But any loans 2018 and forward have a 750 cap. And that limit is per taxpayer, not per property. So if you have, say, two homes, your main home and a second home, you can write off mortgage interest on up to two homes on your tax return on Schedule A.
Even though that other home is not a primary residence,
That's correct. You can have two, but the 750 debt limit is to you, not per home. So if you have, say, a $500,000 mortgage on one and a $400,000 mortgage on the other, both loans are below 750, but your total mortgage debt is above 750. So you will have a limited deduction. Carrying that over now to standard deduction versus itemized deduction. We were going to talk about the SALT limits anyway, the state and local tax limits as it relates to itemized deductions. So in 2018, many things changed in the tax code. And in 2025, many of those changes were made permanent going forward. So we have a pretty high standard deduction limit of like about $30,000. And that's for a married couple filing jointly. That was much higher than it was prior to 2018. And that change alone had the effect of preventing some mortgage interest of being deductible, because unless you could jump over that $30,000 that the government was just giving you with all your itemized deductions, then you weren't really getting a specific tax deduction for your mortgage. That combined with this state and local tax limit, the so-called SALT limit, which is your state income taxes, your property taxes, your car taxes that you pay. Those all get added together on your federal return. And prior to 2018, you could write the total of that off, no matter what it was. Certain exceptions, again, we won't worry about that. Then we fast forward, they put a $10,000 cap on that number as far as a write-off. That's a pretty low number. I mean, for some people, that's property taxes alone. I exceed 10,000. So, it means none of their state income taxes were a deduction. They were only getting 10,000 there, and they still had to jump over this $30,000 overall threshold. So now, unless you had a combination of charitable donations and mortgage interest that exceeded that, you were still standard deduction. So it really pushed a lot of people who prior to that were itemizing and getting some tax benefit from their mortgage interest payments. Many people thereafter were not getting any tax deduction for their mortgage interest payments. And even if they were, it was pretty limited in many situations. And that really created a lot of confusion tax-wise, because people were buying a home and they were assuming they were going to get a mortgage interest deduction for their loan, and they were using that assumption to budget their expenses for their home and justify whether they should buy this or not. When in reality, they potentially were getting, again, potentially a zero write-off on their mortgage interest. So what that means, and this is another really overall theme for all this stuff and the tax code in general. The tax code continues to get more complicated every time they change the rules. There could be certain areas that simplify, but in a large measure, things get more complicated. And really today, the way they get more complicated is everything almost is tied to income levels. So one person could be following a certain rule set because their income allows them to follow that rule set. And another person who has more income is really following almost a completely different rule set, because that's how a lot of the tax code is structured now. If your income crosses a certain threshold, you can lose out on deductions or other tax benefits, and your return really changes in a lot of ways. So it makes it more difficult to understand as just a consumer. Am I getting a tax benefit for this? Or it's no longer a simple question. And the true answer needs to be very specific to that person and their situation. It's unfortunate because it really does make it difficult for just a common person to understand where they're at tax-wise. And it really, my opinion, shouldn't be that way, but that is nonetheless the world kind of that we have. Just one final thought on that. The SALT limit, that 10,000, just changed this year, again, for some people. So
Right.
the new rule effective this year is you get 40,000 maximum on your state and local tax deduction, which again, in and of itself is already over the $30,000 standard deduction, right? But that's not for everybody. If your income is too high, 250,000 for a single person, 500 for a married couple, you begin to lose some of that SALT deduction, and it eventually goes right back to 10,000. So some people will have a $40,000 state and local tax deduction. Some people will have 10,000, and some people will be somewhere in the middle. So again, how do you figure it out, right? As just a regular person, what is my write-off?
You don't really know what that write-off is going to be until the year's over. Because if you had a lot of health expenses, for example, which contribute to that itemized deductions, you could actually exceed that $30,000, and now you're going to be able to write off that mortgage interest too, because it's a combined number. But if you didn't have a lot of health stuff going on, and your interest is maybe $18,000 for the year, and you had very little SALT deductions, you're going to use that standard $30,000 deduction in that case. Right. So there's no way to really predict it.
Yeah, it is. Okay. It is difficult. I mentioned charitable contribution. That's the other kind of the third leg of itemized deductions for most people. You mentioned health costs. Health costs could be a component of that. Health costs have several other bars you have to jump through before you can get a write-off. So we tend to think of, state and local taxes, mortgage interest, charitable contributions as the three legs of that stool. And I think it's important on the charity side to remember that. So, a lot of times your tax burden to the state and property taxes, it's locked in. You can't do a whole lot about it. Your mortgage interest is locked in. You can't do a whole lot about it. Charitable donations can be a lever that you can push and pull to help achieve certain write-off thresholds and allow certain other deductions to become tax deductible. So I just want to throw that in. It's just part of the mix and should be part of people's kind of tax planning when they're thinking about how do we do this? How do we take advantage or maximize our situation?
That's a great point. If you were right on that cusp and you needed a little more in expenses for the charity, you could push your deductions up past that 30,000 threshold.
Yep.
So you have to really plan towards the end of the year.
Yeah. Yeah. And that's another kind of theme of this talk is plan ahead. I mean, really for taxes, the more you can try to plan ahead and try to integrate ultimate tax cost or benefit into your other financial planning and your life planning, the better results you're gonna see over time.
So capital gains, that's a term that a lot of people have heard about, but many don't understand. Can you expand on what capital gains is?
Yeah, absolutely. So in a basic sense, capital gain is when you sell an asset and you sell it for more than you bought it for. That difference, that's your capital gain. That is subject to taxation. And those types of gains have very specific rules of how they're taxed and what tax rates they're charged. And there are certainly some exclusions available for homeowners relative to capital gains. So that's important to remember. A home is really a personal asset, as opposed to, say, a stock or something you buy as an investment that has capital gains when you sell it also. But your home, is really potentially can have a very significant capital gain when you sell it. And it is subject to taxation. And there certainly are some considerations, revolving around that situation of home ownership and capital gains, which I could jump into if
let's talk mainly about the homeownership, the capital gains that applies to just primary residence to start the conversation.
Yeah, so primary residence potentially has up to an exclusion of part of the capital gain, part or all, really, depending on how much the capital gain is. For a single taxpayer, that $250,000 gain exclusion. And for a married couple, it's a $1,000 gain exclusion. And I just want to pause there for a second. So that exclusion is not based on the selling price of the home. It's really based only on that gain portion. So you could be selling a $2 million home, but if your gain on that sale is only, $200,000 as a single person, you'll still be fully excluded and paid no income tax or no capital gains tax on that sale. So the exclusion is tied to the gain amount, not the selling price of the home. There are some rules around that exclusion, as you would imagine. The base rules are you have to own and live in the home as your primary residence for 2 out of the last 5 years. And that goes for both occupants of the home. So the classic example is a married filing joint tax return. Married couple, they're selling the home as a married couple on a joint return, but it's possible they didn't acquire the home that way. The home could have been acquired by one of the spouses, pre-marriage, and the time frame that they've owned it and lived in it could be different for each spouse. To get the full exclusion for a married couple, both spouses need to fully qualify. So you can have a split situation where it's partly excludable, partly not. But that basic test is 2 out of 5. If you look back from the date of sale, look back 5 years, if in 2 years, really 720 days, so it doesn't have to be consecutive or anything, it's a total of 720 days in the last 5 years from date of sale, if you owned it and lived in it as your primary, it is eligible for this exclusion.
Say somebody purchases a home for $500,000 years ago, and now they're going to sell it for $1.2 million. That gross difference is $700,000. And if you're looking at, and it's a married couple, they're going to be limited to a $500,000 exclusion from that capital gains. But there are other factors that go into that too, as far as how that capital gains the basis is calculated.
Absolutely. Yeah.
Okay. So can you expand about that part?
Yeah, absolutely. It's a great point. So the purchase of a home is the starting point for determining what your cost basis is in the home when you go to sell it. But that's not the end of the story, because, home ownership often comes with significant costs for improving the home during the lifetime that you own it. And those improvements also increase the basis of your home when you go to sell it for tax purposes. So if you bought it for 500, but over the course of those 5 years, you've replaced the roof, you've redone the kitchen, redid the bathrooms, added new floors, added a swimming pool, the landscape design and architecture, put an addition on, all those things add to your cost basis in that home when you go to sell it. So it's your purchase price plus all those improvements. That's really your cost basis when you go to sell. Plus, there could be expenses of selling. Real estate commission is an obvious one that counts against the sale price. Any fix-up expenses you had to do to get it ready for sale, inspections, all that stuff, really all of it counts as your cost basis when you go to sell.
So, for example, if they purchased it for $500,000 and they spent $300,000 on improvements over the last 5 years, now that instead of the basis being $500,000, it's actually going to be $800,000, and then they sell it for $1.2 million, but they have real estate commissions, they have other expenses for fixing it up and such. Now, and those things cost, let's say, $60,000. So now we're talking about the difference between $800,000 and $1,140,000. That's the liability portion that could be taxed. But in this case, if it's a married couple, that exclusion of $500,000 would take care of that. You wouldn't be taxed.
It would. And I said we weren't going to talk about California, but just to throw in, California does comply to this rule. So this rule set is exactly the same. If it's exempt from federal tax, it's exempt from California tax too. And I just want to, that's a big one, that the rule set is the same. So if it's zero for one, it's zero for the other.
The other thing that I'm thinking about is, let's say somebody owned that home for a lot longer than 5 years. Maybe it was 10, 15 years, and they made improvements 15 years ago. That means they really need to save all those receipts from 15 years ago, right? Even though they don't need it for
a perfect world.
Yeah. Because if they got audited, they would have to prove that they spent that money.
Correct. But like I said, in a perfect world, that's true.
Right.
We don't live in a perfect world. People don't save records for 15 years. And so what do? Right? It's very common for a taxpayer not to have all the records for all the improvements they did over decades, right? Very common. What do? Well, there's good news there. So the tax code allows for estimating in certain situations. This is one of those situations. So you are allowed on your tax return, if you know 15 years ago you redid that kitchen, don't have any of the records available, but you did it, and you spent about $25,000 on it, right? That's your best recollection. Can you count that as a write-off or not? The answer is yes, you can. And what you should do in that circumstance is, you don't have the historical documents. You need to create a document now, while you're, getting ready for sale, or even after you're sold. Certainly, before you file that tax return, you should have created a new document of what are all the improvements you did in the property over time. So that can be in your own hand, and just, with a timeline. And again, the dates can be approximate, the description of what you did, and your estimate of cost. And you take take the write-off, right? You take that as basis. That's allowed. The key to that is to be reasonable. And that's the key with estimating. And if you are reasonable and you document everything you remember and you have whatever records you have, and you really show that you put an effort developing this cost structure, it's logical, it makes sense, the numbers are reasonable, it all fits with the nature of the property and so forth, it all makes sense. You can take that, and if IRS ever comes and looks at that transaction, you have to remember IRS does not have a secret vault where they have all of your records from 15 years ago either. So they don't know what your cost basis is on the home. This is one of the voluntary parts of the tax code where the IRS is relying on the taxpayer to voluntarily present good and valid and reasonable information in their tax return. So IRS will be looking at that documentation that you provided, and they'll be discussing that with you. And it all makes sense and is logical and reasonable, and they have no other reason to believe that you're, trying to game the system, they'll allow that. There's another topic on home ownership capital gain. So this is what I'll call a split use property. And this is really common for a lot of people where during the period of home ownership, perhaps they had a home office that they were deducting for business purposes. Perhaps they rented out part of the home and had a rental activity on that home. That's really common. And, a question often comes up is, when I sell that home, now what am I selling, right? Am I selling my home? Is it partly a business asset that I'm selling that could be taxable? Is it partly a rental activity that I'm selling that could be taxable? These are good questions, and kind of the general rules again on that. So for a rental or business use, if that is self-contained in the living unit, it's all one unit, say one home, you are allowed to claim the full exclusion on that home when you sell it. If it is a separate dwelling unit, like an ADU, which is very common these days, that potentially needs to, if you sell the property as a whole, right? So you're selling all units on the property, those separate units can be subject to taxation as, say, the sale of a rental or the sale of a business asset, which there is no exclusion for home sale. So you could certainly have, in some situations, a fully excludable sale still. In other situations, partly taxable, partly excluded. The other situation that comes up a lot that impacts this exclusion is, well, it was my home, and then I converted it to a rental, and then I sold it. Or conversely, it was a rental, then I converted it to my home, and then I sold it, right? So both those situations are super common. And they have very vastly different rule sets. So if you convert to a rental and then sell, if you still meet the 2 out of 5, so maybe 3 years ago you converted it to a rental and then sold it, but the prior 2 years was your home, you still qualify for the full exclusion. The other direction is problematic for the exclusion. So if it was a rental, then you converted it to your home, and then you sold it, almost certainly you are going to have at best a limited exclusion. There's a whole formula you have to go through of how many years it was rented and how many years you lived in it and ownership and all that. The bottom line is it can be really limited, your exclusion in that scenario. So that's because that's so common. All those scenarios I just talked about, super common for many people. It can either have no impact on the exclusion, or it can have a major impact on the exclusion. Again, really need to delve into your personal situation, your property situation, and do some advanced planning when you go to sell that.
This is another reason why you need to consult your CPA when you're thinking about selling property.
Yeah, that's the time when you should maybe spend a little money to get some advice that's very specific to your situation.
Right. Okay. That's great. Let's see. How about home office deductions? How does that work?
Great topic. A couple things there. So first of all, again, 2018 changed the world as it relates to home office deductions. Prior to that, both employees and self-employed could get home office deductions. Starting in 2018, Employees can no longer get home office deductions. They can't get any business deductions if what you are is a W-2 employee. For some people, that was a big deduction in their tax return. Salespeople and so forth in particular, spending a lot of their own money to get deals done. And, they just kind of lost that write-off. For self-employed, though, the rules did not change at all in 2018. So self-employed people can still have a home office deduction as always. And the way it basically works, take a portion of your home, say one room in your home is deemed your office, and the square footage of that compared to the square footage of the whole home becomes the ratio where you can take a business deduction, say for things like utilities and maintenance on the home, and certainly property taxes and mortgage interest are part of that too, insurance on the home.
Well, now that we can't take that deduction anymore, it used to be a red flag for IRS. Is that right?
It did. That's really in the past. It's interesting in taxes. I'm sure this is true in other lines of work too. But if something was true in the past, even if it hasn't been true for a very long time, but it was true at some point, it's hard for people to shake that memory.
Right.
So home office is a classic example of that. A long time ago, it was an audit flag. It's not that way today. It is not an audit flag to have a home office connected to your business on your tax return. It's super common and is not an audit red flag at all. But we still get people who ask about that. Oh, I heard I couldn't do that because it's just it's an audit waiting to happen. And it's simply not true today. It comes back down to reasonableness, right? So if you claim 80% of your home is used for business, right? that might be an audit flag. It could be true in certain circumstances, but that might trigger IRS. If you claim, $40,000 in maintenance on the home, claiming a part of that for business, that could be an audit trigger. So it comes down to that reasonableness test again. If it's reasonable, the percentage, the amount you're claiming, it's certainly not an audit trigger and has not been for quite a while.
What about energy efficient incentives?
And they're gone.
Okay.
Yeah, that's basically the bottom line. So the solar credit there is the big one, right? That's a
Right.
30% tax credit. That has been a huge benefit to the solar industry and a huge benefit to the taxpayers, right? A 30% tax credit for something that is a high ticket item, that's a big tax savings. And that all got changed in the new tax law. It still exists as we sit here today. It will exist through the end of this year. If you are either in a solar project right now for your home or you're considering one, you have to have not only the project completed by the end of the year, which means it's connected to the grid and certified, it's ready to go, and it has to be fully paid for by the end of this year. So if either one of those is not true by December 31st, you don't get the credit. So the clock is running and you've got to get that project done and get it fully paid by the end of this year. If you do, you still get the 30% credit. If we step into 2026, it goes to zero. So it disappears entirely on January 1st. So
Wow.
huge change.
And that was from the recent bill that was just signed.
That is from the recent bill that was just passed. So the EV vehicle credit goes away and the solar credit on homes goes away. And it's more than just the solar credit, but that's the big one. That's the one that impacts consumers far and away more than any of the other types of home energy credits. But any kind of home energy tax credit that was in the system now will be gone entirely in 2026.
Okay. Wow.
Yep.
That's big.
It is. That's a big change. Big change.
Yeah. Okay. All right. So let's venture into disaster relief and casualty losses. How does that apply to income taxes?
Yeah. In a lot of ways it does. And so, this is a topic that is an important topic. I'm going to gloss over it a little bit today because it's a complex area There's a lot of tax considerations along the way, which I'll touch on in a second. And it's very specific to each person and each property situation and each disaster situation. So if you unfortunately wind up in a situation like that, unfortunately, with all the other things you're going to have to deal with, you're at least going to have to give some serious thought to the tax implications of your situation. And it really is end to end. So if you think about all the elements of a disaster or wildfire situation with a home, every element along the way, from the disaster itself until the final resolution, has potential tax implications. So the destruction or damage of a home has some potential tax implications. The insurance proceeds received on that situation potentially have some tax implications. Your decision of whether to rebuild or tear down and sell or tear down and keep, all of those decisions along the way have potential tax implications that, again, are very unique to your situation, your property, your disaster. If you're in that situation, your world is already turned upside down and you're trying to replace your entire life almost. You really should seek some tax advice. Again, very specific to your situation. And because the numbers are so big, right, that we're talking about, those tax implications could be big as well.
Okay. That's another reason to talk to your CPA.
Yeah, I guess. I don't want to be self-serving.
You're
but
everywhere.
These are, these are big ticket items that we're talking about: home sales and home ownership. And so the tax situations are big also. So that's when you want to get some advice. When the impact is big, you want advice.
And you're not going to get those answers from TurboTax or.
Well, I don't want to, besmirch, any programs out there or anything, because, there's good information out there. Look, there's information on the web. There's other tax programs you can use, but, to me, the best way to do that is personal with someone you trust, because then you can have a back and forth, a true discussion, and work through the sort of, details of your situation. It's hard to do that with just a software program. This is true for some of the other topics we talked about. It's doubly true for disaster situations. The results of your neighbor have nothing to do with your results. Their situation is different. Their property's different. Their tax situation is different. The decisions they're making could be different. Their level of insurance could be different. Just because your neighbor says, it was tax-free or whatever, or I had to pay a bunch of tax, that potentially has nothing to do with your situation. It's unique. And therefore, get advice that is unique to you.
That's a great point there, George. Let's talk about rental properties or investment properties. A lot of my clients own rental properties, and it's totally different tax situations for them.
Real different.
Well, let's start with depreciation, because a lot of people don't understand what depreciation is and how it applies to rental properties. Yeah.
So in a kind of big picture, a general situation. So when you buy a rental property, you are allowed for tax purposes, there's a specific form. Schedule E is the rental activity form in your tax return. It reports the rent income you receive, and then has a place for all of the expenses you had on that property. And most of those expenses are cash you're paying out, right, for utilities or whatever. The one expense that is not based on that, it's purely based on the cost basis of the property, is depreciation. So the way it generally works is when you buy a piece of real estate that you're going to rent, in that first tax return that you report that activity, you can take the purchase price of that property, and you really have to initially break it into two components. There's other components it could be broken into. We'll talk about that a little bit later, perhaps. But initially, you've got to separate what is land that I'm buying, which is not allowed for depreciation. You cannot depreciate land. So you've got to identify land value versus building value, and it's the building value that you can depreciate. There is no specific way you have to do that. It's not necessarily tied to the property tax bill, although that is certainly, one way to do it, with the property tax being reset on a purchase. And you can look at the land and building. Once the supplemental bill comes out, you can see that, but sometimes that doesn't come out for like 2 years. So
Yeah.
doesn't help with your current tax return. So again, you have to use a reasonable method and reasonable allocation of what is non-depreciable land and what is depreciable building. That depreciable building piece, it follows a formula. There's IRS tables that are out, and you start to write off a portion of that building over time. For residential rental, it's 27 and a half years. So whatever that cost number is, it's broken up into 27 and a half equal pieces, and you take that small amount as depreciation deduction every year. For commercial building, it's 39 years, so it takes quite a long time. And for residential, it's 27 and a half. So you get this kind of free deduction on your tax return for that depreciation. So, and I want to talk a little bit about, just for a second, about depreciation on real estate, which is extremely unique in the tax code because it's one of the very few assets that typically appreciates in value during your ownership period. And at the same time, you get to depreciate the cost of it on your tax return. That's a pretty good write-off. That is unique. You think about a piece of equipment or a truck or something, which you can also depreciate, say, for a business. The second you buy it, it's now worth less than when you bought it a minute ago, right?
Right.
And so it makes sense that you can depreciate the cost because the value in economic terms is depreciating. Whereas again, in real estate, typically you're getting an appreciating asset and you're still able to depreciate the cost of it against your income taxes. So it's quite a beneficial tax deduction, but it can create some problems later on. So depreciation, the key to understanding depreciation tax-wise is that it is a temporary tax deduction. So you get the tax deduction each year while you own the asset until its life runs out. But when you sell, you basically have to give all of that depreciation back as taxable income upon sale. And so
capital gains again.
yeah, it's a capital gain. It actually is, especially for real estate, it's a special category of capital gain that is potentially subject to a higher tax rate than, say, the pure capital gain on the property, right? So, if we again just look at buy and sell, right? We bought it for 3, maybe we're selling it for 5. So our pure capital gain is 2, but of that 3, we depreciated $100,000 of it, right? So now our gain is 300,000, and that 100,000 is subject to a higher tax rate potentially than the pure capital gain. So that one issue of having to pay back the gain on that depreciation upon sale, it can be quite a shock to real estate investors who do not realize that's the way it works, that you basically pay it back on sale. So you could have a huge gain when you sell a property and a huge tax bill that you were not anticipating because of this sort of give back on depreciation. It's great during the lifetime, right? But you get like a little slice of it, each year. So it's kind of subtle. You maybe don't even notice the benefit you're getting during the lifetime of the rental. But if you've owned it long enough, upon sale, it can really be a crushing blow tax-wise upon sale. One other thing to touch on that. So because of that, some people say, well, I don't want to claim depreciation on that property. I don't want to do it. Don't put it on my tax return. The problem with that is depreciation is not an option. It is required that you depreciate that asset over time. And if you don't, upon sale, you're still treated as if you did. So just leaving it off the tax return is not really an option. It's
That was
just
one of my
something.
next questions.
What's that?
That was one of my next questions is,
Yeah,
well,
yeah.
can we just avoid
It's a
it?
common question. Yeah, but the key with depreciation is it's real. It's going to impact the sale one way or another, and you just have to make it, again, part of your tax planning to understand when we sell what the implications of selling are, what the true implications of selling are.
Right.
Yep.
Okay. This is a perfect example. If somebody bought a house for a rental property for $300,000 and that depreciation deduction is about $11,000 per year.
Mm-hmm.
So if they own that property for 10 years, their basis, instead of being 300,000, now it could be 180,000.
Yep.
And then that 180,000 versus the sales price of the property, that difference is what can be taxed as capital gains.
Yeah, it can be, it has a huge impact, especially if there's still debt remaining on the property, because you literally can wind up in a situation where the bank and the IRS are getting more money than you are, when sale drops out. And that can be quite a shock to the system. We have clients all the time say, oh, I'm going to sell my rental property. I bought it for X, and so I know I'm going to have this gain. And they, completely disregard the depreciation factor just because they just don't understand it. And it's not their fault. I mean, it's a little quirky the way it works, and you don't see it really. It's kind of hidden, in your finances, but it's real, and it can have a devastating impact tax-wise. That's why a lot of people do 1031s.
That was my next subject
and just,
to get into.
One other thing before we get off of that, I just want to break down the other thing that I think confuses taxpayers is, many people are familiar with the term capital gains. They're also familiar with the 15% capital gain tax rate. That has really wormed its way into a lot of people's understanding, especially people who are investors one way or another. They're used to that kind of concept, right? So they think when they sell the rental, okay, I've got this gain, 15%, that's my tax cost. Well, most of the time that is not true, and it's potentially much higher than that, as follows. The capital gain rate typically is 15%, can be as high as 20%, can actually be 0 in some instances, but 15 is a good general rule. But that depreciation piece that you have to pay back, that maxes out at 25%. You could have part of the gain at 15, part of the gain at 25%. Again, in other situations that are not that difficult to achieve, especially if we've got a big sale, you could have an extra federal tax of about 4%. That's the net investment income tax. So you could have federal taxes of some at 15, some at 25, plus the whole thing at an extra 4%. And then California, right, is going to get their tax piece too. And we use generally like 10% as kind of our guideline rate for California. So if you add that all up, I mean, instead of 15%, you could be at a total tax rate combined, maybe 40%, on that same transaction. And that's a big difference between what they initially thought the cost would be and what the true cost will be. So I just wanted to throw that in there a little to give some perspective.
That's a good point. Yeah. And one way to avoid the capital gains is when you sell that rental property is to buy another one and do a 1031 exchange. Well, that wraps up part 1 of our deep dive into tax benefits for homeowners and real estate investors. We covered everything from deductions to depreciation, but there's still more ahead. Next month, we'll release part 2, where we tackle advanced strategies, recent policy updates, and real-world tax planning tips to help you maximize savings and stay compliant. If you found today's episode helpful, make sure to hit subscribe, share it with a fellow homeowner or investor, and turn on notifications so you don't miss part 2. Thanks for watching, and I'll see you soon.
Thank you for listening to another episode of Home and Finance Insights. If you found this information beneficial, please like, comment, share, and subscribe so that you won't miss future episodes. Kevin Mathews, NMLS number 234253. California DRE license number 00884-691. Kevin can be reached at kevinmathews.com or email kevinmatthews@empirehomeloans.com. Empire Home Loans, Inc., NMLS number 1839243. California DRE license number 02086593. Refer to nmlsconsumeraccess.org to see additional licensing information. The corporate office address is 4401 Hazel Avenue, Suite 225, Fair Oaks, California 95628. This communication is for informational purposes only. This is not a commitment to lend. All programs are subject to change or cancellation at any time and without notice. Empire Home Loans, Inc. supports equal housing opportunity.